Hello, everybody. I think I know many of the people that are here today. I'm Paul Holden, President and CEO of the Burnaby Board of Trade, and welcome to today's event. Before we start, I'd like to take a moment to recognise that we're on the traditional homeland of the Hunkaminam and Squamish speaking peoples, and to extend our appreciation for the opportunity to hold a meeting on this territory. I'd like to thank our annual partners, who are the organisations who stand out as top corporate citizens in Burnaby and support our work throughout the year. An excellent group of organisations, as you can see from the list, and you can see their logos on the screen right now. So jumping forward into today, I'm pleased to be joined by Marc Desormeaux for an overview of the economic outlook for 2022. Marc is a senior economist in Scotiabank's economics department, where he's responsible for regional economic forecasting and commodity market coverage. During this time at Scotiabank, he's produced research on a wide range of sectors, including real estate, energy policy, and federal and provincial government finances. And prior to joining Scotiabank, Marc worked in the economic forecasting division at the Conference Board of Canada. So Marc, I'll hand over to you now, and hopefully you're able to share you're still a co-host, so you can share your screen, and I'll hand over to you and look forward to hearing what you have to say today.
Thank you, Paul. Thank you for that warm introduction. Thank you to the Burnaby Board of Trade for having me here today. Much appreciated. Always appreciate a chance to share some of our forecasts and our views on where things are going in the Canadian economy and around the world. And it's always great to chat with people who are on the ground, with the business people and the policymakers who are there working their way through these issues. Just to get your perspective on various things helps us out, just as I hope this presentation can help you out as you're making major decisions for your organization. I'm going to talk today about the economy. Now, one word before we begin: all of our forecasts were done before this recent situation with Russia and the Ukraine, so that none of those impacts have been factored into our projections yet. That is something that we're watching very closely, as you can imagine, and we'll be updating things shortly. So a few key messages from the presentation today. I'll take you through some slides, and then I'll be happy to answer some of your questions. The first thing is that we are seeing the global economy recover. We've had positive news on that front. We're coming out of lockdowns increasingly, demand is strong, but the Omicron variant has slowed things down a little bit in the first quarter. The big overarching theme of the global economy, partly related to that, is one of supply and demand disequilibrium. We have shortages of input products that are being caused by supply chain issues, inflation that is directly related to that, and then also a shortage of labor, which is impacting businesses around the world and in Canada in particular. So those are really big stories. As a consequence, aggressively over the next couple of years in response to the inflationary outlook and the need to bring economic growth in line with potential. And then finally, turning to BC, there's a lot of good news for BC in particular relative to other provinces, but for all provinces, for all of Canada, we need to think about our long-run growth plans, stimulating productivity and economic growth over the longer run. First, I'll talk about the Canadian economy, macro backdrop, then the BC economy, as I mentioned. So let's start bigger. The story in our last economic outlook, which was published in January, was the Omicron variant. Because of the rapid spread of this variant, countries around the world implemented new restrictions to try and slow its spread. That's something we see on the left-hand side here, which is the result of the impact on economic activity. We revised lower our estimate of first quarter growth in 2022. You can see that on the right-hand side with the blue bars indicating the new forecast, just because of that imposition of new restrictions on where people can move and what they can do. Now, the good news is that we've gotten Omicron more under control. It has been short-lived as we've anticipated. And because of that, there's been some easing of restrictions around the world, and we now see a bounce back in economic growth in the second quarter, which should continue the recovery going forward for Canada and across much of the world. I'd like to talk now about supply chains. These have really been an issue over the last several months, and one that is impacting many aspects of the global economy. What's happening right now is that demand is very strong. We've reopened from the pandemic. There have been some temporary restrictions that have slowed things partly, but the overall trajectory has been strong. Demand is strong, employment is recovering, people have pent-up demand and money saved up that they haven't been able to spend for some time. There's a desire to spend and to produce more after this period of being closed off, of being shut down because of the pandemic. Now, in spite of all that demand, transportation networks, production, have not been able to respond as quickly as they need to meet that demand. Supply chains are unable to transport goods to where they need to go fast enough because we are in this world of partial reopening and reopening lagging demand. And as a result of that, there are many products, either finished products for consumption, for purchase, or input products that go into the production of other goods and services that are in very short supply right now. So if we look at this chart here, this is an indicator of supplier deliveries. So measures how quickly firms expect to receive the products that they need in order to be able to produce whatever it is that they produce. What we can see is that because of these supply chain issues, delivery times are very long. It's taking much longer for firms to get the products that they need than it has in the past. In fact, we're pretty close to where we were in terms of expectations, in terms of sentiment during the peak pandemic lockdown period in that first wave. So there really is a shortage of a lot of these different products across manufacturing and services that are needed to produce. And the central tenet of economics, if you will, is that scarcity of something creates price pressures. It creates things becoming more expensive. And that's precisely what we're now seeing. Because of the impact of this product scarcity across the supply chain, prices have been appreciating very significantly. We recently got a print for January in Canada where inflation on a year-over-year basis was growing faster than it had in 30 years. So what we did at Scotiabank was we looked at how these supply chain issues might impact inflation, what might we see under different situations of reopening and easing or persistence of some of these supply chain constraints. What we found is that there's a very strong correlation. And even with some easing of supply chains in the next few months, we do expect that to happen. But even if the easing happens very quickly, there will be a persistence of inflation over the next couple of years. So everything's more expensive. And because of these supply side issues, we see persistence of price pressures over the next couple of years. Those price pressures should become more modest as we persist through this year, but we're still expecting to be in kind of the upper 2s to even 3% year over year by the end of next year. Longer disruption, it could be more elevated, up towards 4%. Shorter, we might be in sort of the 2.5% range, according to our models. The other aspect of this supply side kind of challenge is the labor market. Firms are reopening, they want to produce more, but in many cases they can't because they can't find the people with the right skills to produce whatever it is that they produce. And this shortage of skilled labor is actually identified by independent business within Canada as the most pressing constraint on their profit opportunities, on their growth. That's indicated by the red line on the left-hand side there. So this is something that's holding back growth in Canada. And BC is actually the province with the most significant degree of labor shortage at this particular moment. It's got the highest job vacancy rate of any province, so this constraint is of particular relevance in British Columbia. The consequence of all this, we think, is that we're going to see rates increase fairly quickly over the next couple of years. 100 basis points this year, another 100 basis points next year. I think that the Bank of Canada will move in March, and these increases in the cost of borrowing will be used to try and rein in the pace of inflation to bring it back towards that target level of 2%. So again, 100 basis points over each of the next 2 years is what we're projecting. We'd be getting up towards 1.5% by the end of this year, and then 2.5% by the end of 2023. So let's go into BC now. We're fairly optimistic about British Columbia's economic outlook. If you look at our most recent forecast, we had BC near the top of the table. We felt that they were last year. Looking at all the data, we expect them to continue to be a strong performer in terms of economic growth and employment relative to other provinces. And there are a few reasons for that. One trend that we've seen over the last several quarters during the pandemic has been that a lot of people are moving to BC, particularly from Ontario. So this is something that has, in fact, more people are moving from Ontario to BC than we've seen since the particularly bad recession that Ontario went through in the early 1990s. So this reflects a few different factors. One of them I've shown here is the price of housing. Yes, Vancouver is an expensive city. It has traditionally had higher home prices than Toronto has. But in fact, during the pandemic, Toronto's home prices have caught up with Vancouver, and it's now more expensive on average to buy in Toronto than it is in Vancouver. So we think that that's contributing to some movement across the country. In addition to that, BC has had some success controlling COVID-19 relative to other provinces, and the overall capacity that workers have now to work remotely is something that opens up a lot of other places to live that might not have been available to them before the pandemic hit. So BC in particular, the province was benefiting from interprovincial migration before the pandemic, but that effect has been supercharged during the pandemic, in part because of working from home capacity and in part because of housing affordability. Another thing I'll mention as an advantage for BC is that its key commodities are in demand. Very strong export gains last year in the province, and that was supported primarily by price gains for a range of different products that BC produces. So natural gas prices went up, gold and silver very strong as well, some of the base metals, copper and nickel. And according to our forecasts, many of these products have very strong outlooks. Copper in particular, we see attaining an all-time high price by the middle of this decade as we get more and more into the green energy transition, for which copper is a very important input product. So price gains of late have really supported BC's recovery, but we see opportunity for further gains in the coming years as that transition persists into green energy, and BC's in position to benefit from it. Another thing that I'll highlight for the province of British Columbia is the tech sector. Lots of growth in the last several years. Employment gains within the sector have outperformed many major US hubs, California and New York. And the sector actually grew by almost 6% during the pandemic year, which was a pretty remarkable result. Telework capacity within the sector is certainly something that contributed to it, and we saw gains across other provinces. But BC had the strongest gains in real terms in information or communication and communication technology GDP over the pandemic year. There's a lot of momentum here. It's a high wage sector. More and more unicorns are being identified within the province. And so this is something that has a lot of potential. And BC is, again, well placed to benefit from gains within this industry. Fiscal positions, another advantage for the province, one of the lowest debt levels projected for the next several years among Canada's provinces. Net debt to GDP ratio in the 20% range is pretty good, compares pretty favorably to a lot of jurisdictions out there. Yes, that is expected to increase modestly over the next couple of years, but we still think that this is a province with a strong fiscal position, and there's a lot of prudence built into the fiscal plan, which suggests there's some upside and additional fiscal room to deal with unexpected challenges for this province relative to others. So the final thing I want to talk to you about is long-run growth. Some of you may have seen an OECD report a few months ago that projected that Canada would have the weakest per capita growth among G7 nations. Big reason for that projection has been the pace of business investment within the country. If we look at capital stock per worker, to which business investment contributes, this is something that drives an economy's long-run capacity for growth alongside population. Canada's had a lagging performance on this indicator for a number of years. It's fallen behind other G7 countries, particularly the United States. And as we can see in the last couple of years, even with the boost that we've gotten as the economy's reopened over the course of 2021, growth in capital stock in Canada has been pretty weak. BC's been performing a little bit better than other regional economies, supported by major project activity, particularly in the LNG sector. But still, what we see overall is this trend towards weaker capital stock accumulation, weaker business investment. So what we've argued for at Scotiabank is that this really needs to be a focus. Productivity needs to be a focus. Long-run growth needs to be a focus in the federal budget, in the provincial budgets. And attracting investment within the country will be critical if we are going to continue to grow and enhance the quality of life for people working and living within Canada. So that's something we've been advocating for some time, and we'll be watching closely as the federal budget is released. Just to sum up again, we've got a recovery ongoing. The Omicron variant has delayed it, but we still think that we're going to see growth continue as we progress through this year. Supply-demand imbalances are the story of the global economy, especially in Canada. Input product shortages because supply chains haven't been able to respond quickly enough. That's led to inflation, and it's also contributed to labor shortages, which are holding back growth across the country. We expect more aggressive rate hikes, 100 basis points increase in the Bank of Canada's overnight rate in each of the next couple of years, bringing us from 0.5% to 2.5% by the end of 2023. And then finally, the BC economy, we think, has a lot of advantages. Our outlook for it is stronger than it is for most other provinces. But all economies now, as we reopen and come to terms increasingly with the impacts of the pandemic, need to be focusing on long-run growth and particularly stimulating productivity and investment. So I'll stop there, and I'll be happy to answer any questions.
Thanks very much, Marc. Excellent, thank you. I've got a few questions in my back pocket, but let's give our guests and members some chances as well. We've got one question posted in the chat room at the moment. I'd encourage everybody, if you have any questions for Marc, put them either in the chat or preferably the Q&A, and then we can get to them that way. So Marc, a question about BC with a strong GDP growth, but also the highest in labour shortages. So there are questions around how does BC's wage level compare to other provinces now, and what is your forecast in that area? And is BC competitive enough to pass on its high GDP growth to attract people to fill that labour shortage?
Mm-hmm. Yeah, great question. BC, I guess the first thing I'll say is BC's wages are below the national average. So within Canada, it's a low wage jurisdiction, and that is a concern. I would say that on that front, I'm encouraged by the growth in the tech sector because that is a high wage jurisdiction, or a high wage sector, pardon me, and further growth in that can help support stronger wages overall and a higher quality of living for people within the country. And I would also say, in terms of competitiveness, there is a competitiveness relative to the United States. Wages are lower than they are in many U.S. hubs, but that also opens up opportunities for lower cost investment when the labor bill is a little bit shorter. So there are some encouraging developments on that front. Again, I would be concerned about the housing affordability story. That's something that's been present in BC for a long time. But the fact that Toronto has seen so much increase relative to BC, Vancouver suddenly is looking a little bit more competitive on that front than it has in a number of years.
Thanks. And on that housing question, I wish we all had a crystal ball on this, but any thoughts on what you think can be the sort of best case scenario for housing prices? Obviously, we're focused here in BC and the Lower Mainland. Will higher interest rates, which you touched on, lead to slower appreciation? Is there a time frame where you think wages might catch up? And any thoughts on the likely scenarios, or are we just stuck with a situation where prices are just going to keep on going up and up and up?
I suspect that interest rate increases will have an impact on the margin in terms of demand for housing. When you see 200 basis points over the next couple of years, that will have an impact. That impacts the interest rate that people pay on the loans that they get for mortgages. So that's certainly something that should have an impact on the margins. But the issue with housing, which we've said multiple times, I think we're right in line with most people, is that this really is a fundamental imbalance between demand and supply. There needs to be more housing built. It needs to be built more quickly. There's a lot of work out there that's talked about zoning restrictions and various other factors that constrain the ability of construction to respond to demand. But that's really what needs to be tackled. We need to find a way to build more. We need to find ways to ensure that the construction sector can build not only more units, but the right kinds of units. So, there's a lot of talk about the missing middle, these sort of medium density unit types that will be critical to have as our population increases and is supported by immigration. So, that's really what needs to be done. Dealing with affordability in a permanent, sustainable way is something that takes some time. So I'm not saying, we're certainly not projecting that increasing construction is something that will, result in significant affordability gains just within a year. It's going to take time. It's going to take effort and discipline on the part of policymakers to stick to the plans. But that's really, I think, what needs to be done. We've written a number of different papers on that. So supply is really the issue on affordability.
And that missing middle is something that we've had a lot of conversations about, and I think we see in a lot of places, the construction of the high rises going on, and a lot of that type of inventory for homes. But it is that area of the growing families, or the people that want to move into the next tier of, if you like, of housing, where there just seems to be that shortage, and it's and as you say, that's one that takes longer to fix. Just on you mentioned about something that you've been advocating for, is the need to spur kind of overseas investment into Canada, and obviously from our perspective here, we're looking at BC, and also the productivity issues of raising productivity levels. And you've been talking for a while about that, and we've been talking and hearing for a long time about that. Any thoughts on areas in which advocacy might focus?
Yeah, there are a few. I mean, I think sectoral experts, people who work in specific industries, would know better which policies are holding them back than I do. But there are a few things we've talked about. Certainly the taxation system needs to be looked at. We need to make sure that we're competitive, that business costs can be at the right level to stimulate investment. We have advocated in the past for further accelerated depreciation allowances, so tax breaks on the kinds of investment that generate the most productivity gain, usually in machinery and equipment. Versions of that were put in place in the past at the federal level and the provincial level. Our chief economist in particular has argued that those kinds of measures could help stimulate investment in an environment where there's a lot of uncertainty still about the virus and various geopolitical effects. The kind of population growth approach is important to that as well. We've talked about using immigration to fill skill shortages, looking at the skilled trades and the role that they can play in filling those as well. We need infrastructure built. We need business investment to support non-residential construction. We're going to need people to work on those projects. And so the skilled trades can help in supporting that goal as well. So those would be kind of three things we've talked about that I would mention. But of course, every industry has its own concerns, and those of you who work within the sectors would really know the best specific approaches to dealing with regulatory burden and costs that you face that are holding back investment.
Yeah. Thank you. Thanks. And you mentioned about the labour shortages and some of the challenges around that. The BC's new labour market outlook is forecasting 83,000 jobs will go persistently unfilled this decade unless measures are taken to bring in more people into the workforce or to automate some of the jobs. It's going to have a huge effect on the economy, isn't it, if we can't fill those jobs? And I'm not asking you for what your thoughts on a quick fix might be, but any have you seen in other jurisdictions or whatever initiatives or efforts put in place that have addressed that?
Well, I think you need to look at education over the longer run. Are we training appropriately? Are people developing the skills that are necessary in the labor market that can contribute to growth? What's demanded by employers? What's the future looking like? So that's part of it. The immigration system has to play a role, bringing in skilled workers who can fill jobs and contribute positively to the economy. As I mentioned, skilled trades can play a role in that as well, particularly in the construction sector. I know that's an industry that's had a lot of challenges with job shortages in BC in particular. So that's one thing. And then, another thing we've talked about is kind of flexibility on the part of employers. We've got people wanting more and more to be able to work from home. There's been a shift in some of the thinking on that front since the pandemic has taken hold. And so we may be moving into a world where there are different desires, different requirements from employees, and those should be considered by anyone who's hiring, in addition to the general kind of questions around compensation and skills and who brings what to the table.
Yeah. I guess on the remote working area that you touched on, there's been a lot of talk around the impact of that on some of the downtown cores in the major cities, not just here in Canada, but everywhere. Do you see a big kind of economic change in terms of how the downtown cores are set up from a business and societal perspective?
Well, in some ways, we're already seeing changes. We've seen people move. I talked a little bit about the interprovincial migration flows. There's also, if you look at the city level, evidence that people are moving further away from large urban centers into smaller communities. We've seen house prices appreciate very significantly in smaller communities that haven't traditionally been magnets. So there's already been a change in where people are moving. And if you look at a lot of the survey data, a lot of the studies that are out there, it certainly appears that some form of working from home is here to stay. Most people expect to continue at least part of their work remotely, if not all of it. So I do think that's going to have an impact. That'll make a difference in terms of whether the downtown core or the suburbs or communities further afield are more desirable to people. but I certainly wouldn't bet against the downtown core. I think still where population density is, there's still lots of things going on. There's still a lot of business activity. Most firms still expect some, if not a majority, of business activities to occur downtown. And as we get the pandemic more under control, I think that will be the case. So, I guess that's a kind of non-answer, just to say that we're already seeing some of the transitions happening. People are becoming more comfortable working remotely and living further away from big population centers. But I don't think we're going to see the death of downtown or anything like that. I think the big city centers will always be a magnet for people.
Yeah. Just jumping around a little bit, Marc. People have been talking about government debt and what we can expect to see going forward. And we're seeing huge levels of debt provincially, nationally. What are you thinking of the likelihood of changes to income and sales taxes and other mechanisms to help government to address that debt situation? What are you seeing is the likelihood in the short, medium, and long term?
Yeah. We're just starting budget season, so we're getting through those and watching very closely what governments put out. Generally, what we have been seeing so far has been more focus on expenditure restraint and less on revenue generation. Part of that is just, a natural easing of COVID, one-time or temporary COVID-19 spending that we expect to go down. So that seems to be mostly the focus among the governments that are consolidating. It's more about reining in spending, bringing spending in line with targets. And that's kind of the way that's been so far indicated will be how we get to, more normal fiscal conditions over the medium and long term. In terms of the overall debt levels, yes, efforts should be made to try and keep those sustainable over the longer run. I think when we look at a province like BC, though, getting up towards 20-25% of GDP on the net debt front, that's not really an indicator that concerns us over the longer run. It still compares pretty favorably to other jurisdictions. And that was something that we put in our budget write-up the other day. Yeah. But I guess to answer your question, to summarize anyway, I should say, every province, every jurisdiction has its own kind of debt targets. We've been encouraged by improvements in the fiscal situation that we've seen over the last few months. But generally, it looks like, at least from the plans released so far, expenditure is going to be how sustainable debt levels are reached over the medium term, as opposed to taxes.
Yeah, and talking about budget season, anything stand out for you that you thought was missing in the provincial budget that was released earlier this week that would have supported or could support investment and growth?
Well, I think I'll defer on that one, just because I actually didn't cover the BC budget for our team. My colleague Laura did that, so certainly I can share our report on that. But generally, what we felt was that again, the debt levels were still fairly low relative to other jurisdictions. That does provide an advantage in terms of sort of private sector views about the debt sustainability and investment climate within the province, and then efforts to deal with costs related to COVID and sort of climate change concerns over the medium term. These are meaningful policy priorities.
Yeah. We've spoken a little bit about interest rates already, and we're looking at some interest rate increases coming up as an effort in many respects, obviously, to tame inflation. The tactic usually works, but sometimes there are some unintended consequences of that. Any thoughts or comments on how resilient the economy will be should it be facing a series of rate increases in the next year or two?
So the question is about rate increases and the extent to which that could impact economic growth.
Yeah.
Yeah, it's a good question. I think, as I said before, on the margins, this is something that impacts consumption spending. It impacts borrowing activity. Higher borrowing costs, particularly in the housing market, that should contribute to more modest activity on the margins. But if we look at the amount of assets that have been accumulated over the last few years, particularly on the real estate front, the household saving rate is very high relative to history. People have saved up during the pandemic. We don't anticipate some kind of massive slowdown related to rate increases. We think that this will have a marginal effect, but not result in some kind of really significant growth slowdown. That doesn't mean that some households or some people won't be impacted. We're looking at averages across the entire economy. There are people who are indebted, but the overall level of wealth accumulation and saving that's occurred over the last several years suggests to us that there is cushion to deal with higher costs associated with rate increases.
Yeah. I'm going to put you on the spot just on one question here, and I know it's top of mind for everybody at the present moment, and not expecting you to have the definitive answers. But obviously, the news today of the activities in the Ukraine. Any initial thoughts on how this might impact the markets here and in Europe?
No, certainly. Well, first of all, this is a humanitarian conflict, and we hope that it can be resolved, and our thoughts go out to people who are impacted by it. From an economic perspective, the first and most obvious thing, we have to look at the impact on energy prices. Russia is the third largest oil producing country in the world. If it is a significant natural gas producer as well, fears about supply coming out of those countries tighten the market at a time when we're already pretty tight. We've seen oil prices go up above $100 a barrel in the last couple of days. So certainly it appears, based on sort of the supply concern dimension, this is something that could be driving energy prices pretty high for the next couple of, for however long the conflict lasts. So that's something to be mindful of. And oil prices have myriad implications for the Canadian economy. Now, if this is a military conflict that creates a lot of uncertainty, and there's certainly evidence that it has, that also has an impact on risk sentiment and could weaken certain assets. We've seen the US dollar gain out of that flight away from uncertainty, in part because of this. So that's an additional consideration to the impacts of the conflict. And then the other thing we definitely have to think about in the current environment is how this might affect transportation networks and supply chains. We're already dealing with an inability to get the goods we need in a timely and effective manner because of the way supply chains haven't been able to respond. If this is something that contributes additionally to that, we could have further input product shortages and price increases associated with that. So that's kind of the initial read, but of course we're monitoring this very closely. We'll be considering it in our forecasts going forward, and there's a lot of uncertainty, a lot of different considerations to be made. Yeah, no, exactly.
Exactly. Yeah. So that, as you said at the beginning, hopefully this is something that can be resolved very much in the short term for all the reasons that you outlined. Moving on to a different subject, and you touched on it a little bit earlier about environmental issues, and ESG is something which is a very important topic right now. It's something that, as an organisation, has been very much on our radar in terms of working with business and government in the areas of environmental, social and economic responsibility. In terms of looking forward, obviously that area was a big feature of COP26 and was mentioned in BC's, as you touched on, new economic plan. Any thoughts on how ESG may or may not shape how capital investment and foreign direct investment flows?
Well, I'm not a climate specialist, so I don't know how much I can offer on this in terms of specifics, but certainly this is something that's front of mind. More and more investors are looking at the environmental friendliness of projects and companies that they're getting involved with. There's certainly, we've already seen commodity prices respond to ongoing trends, shifts in the way people consume and what kinds of products they buy and use. So all that to say, I think it's clear that this is going to be a very significant issue and question going forward. The whole ESG, green energy, environmentalism kind of question, and it's something that all organizations should be thinking about as they plan out the next few years.
Yeah.
But again, I will highlight, on that front, BC certainly has some advantages. The copper deposits, its export ties, its ability to produce those. I know BC's mining sector has gotten good marks on its kind of emissions intensity. So there are opportunities there, particularly for British Columbia.
Yeah, certainly. Thanks, Mark. Obviously, business, nobody can look forward or expect to look forward with tremendous degrees of certainty on what's going to happen in the economy and how it might impact businesses. But, some form of predictability is something that businesses like to have so they can plan and structure what they're doing in the future. Notwithstanding the conversation we've had about the overnight events in Europe, how do you see things provincially and nationally in terms of businesses' ability to be able to plan with some degree of comfort and predictability going forward?
Yeah, well, I think that's really, in many ways, one of the most important questions to ask. We're in an environment of a lot of uncertainty, and so that should certainly, businesses should recognize that, and I'm sure it's challenging to plan at this point. I think in terms of our economic outlook, we see business investment recovering in the next couple of years. A lot of that has to do with COVID becoming more manageable, a little bit more, predictability on things like restrictions and various aspects of dealing with the pandemic. We think that that's something that should encourage investment activity and support the overall climate. Over the longer run, those productivity questions and the capital stock per worker, those are big concerns. So there really needs to be an effort to stimulate that, to encourage more investment as we come out of this pandemic. Otherwise, there is a risk that Canadian growth won't be very strong over the long run.
Yeah, exactly. Well, thanks very much, Mark. I think we've kind of gone through the questions that we had submitted and that I had in my back pocket. Any kind of closing thoughts you'd like to share for our members here who are across a wide range of sectors and size of company and what have you? Just any kind of little thoughts on what they might do to prepare themselves for what might be lying ahead?
Yeah, that's a great question. I think the first thing I would just say is thank you. Thank you for joining. It's great audience today. I appreciate the questions you've provided. Please feel free to follow up with me directly or with anyone on my team if you're interested in specific questions. I know I just saw in the chat a few people had trouble with connection, so feel free to follow up. What I would say, I guess, as a closing thought is we're recovering. We're encouraged by the pace of recovery that we've been seeing in Canada, in British Columbia in particular. There are opportunities on the horizon, particularly around the ESG opportunity, as I mentioned, again, particularly in British Columbia. But it is important, especially as we deal with all these uncertainties, for policymakers to be looking to the future, to be looking to long-term growth, and finding ways to stimulate investment. So that's really what's important, in one of the most important concerns for the Canadian economy at this time. And I guess I could say that you as business people will be at the forefront of that. You're the leaders in this, and you can play a role as well in advocating for growth supportive policies.
Thanks a lot, Mark, and thanks very much for joining us today.